Hello everyone. Could you please give me a sign that you can hear me? I'm hoping that everything is transmitting properly, but in the past we have had some small incidents. So I want to make sure that everybody's there, you are being able to hear me, etc. While I hear your oh wonderful. Oh, okay. I see it sounds is great. Thank you so much, and thank you for spending a part of your day with me today. My name is Aldo Lagrut. I'm from the Technical Analysis Institute, and today I'm going to ask you to please allow me a few minutes to present to you without looking at questions, because I'm in a different setting. I have two computers and I'm all discombobulated, and besides, that way we don't interrupt the flow of the presentation. And thereafter, when I finish presenting the basics I want to cover today, then we can get into a conversation and you can ask everything you want and need. So for the moment, don't feel that I'm ignoring you. Okay, so thank you for that. What you have in front of you is the the points that I want to make sure to cover for you today. Okay, I have been extremely excited for this because I'm very happy to say that the strategy we presented on Sunday's video was very well received, because it is truly a very effective one, and it's a strategy that allows us to generate money consistently. However, I want to make sure you understand I don't claim this strategy or any of the strategies I have presented thus far or in the future to be 100% effective. That would be silly and it would be a huge lie. In fact, the only thing in trading that is 100% is the fact that if you trade, you lose money. And if you don't know what you're doing, you're going to lose a lot of money. That's it. That's the only thing that is certain in the trading world. Hence, in our channel, we try to help you know better what you're doing so you don't lose a lot of money. And the most important thing to understand at this point is that for any strategy to work, you need market context. That's why the three prerequisites for any strategy to work are forecast, timing, and trade management. You may want to actually take notes of that. There are three elements that you need for any strategy to work. If they are not there, the strategy might not work as well. So they are forecast, timing, and trade management. Forecast gives you that market context we always talk about whenever we speak about strategy. And when it comes to forecasting, and I would add, when it comes to trading and analysis, nothing, in my opinion, comes close to the Elliott wave principle. That's why in our channel, we will be posting an entire training on the Elliott wave theory, probably starting this month. So you can learn how to forecast and then apply all these wonderful strategies we have been presenting with even higher rate of success. Having studied all the different fields of technical analysis, I can tell you this very sincerely. Knowing Elliott doesn't make us clairvoyant, and it doesn't make us billionaires either, or infallible, but it gives us a fantastic edge that it is difficult to match. It gives us the ability to have market context, and it is that edge that increases the efficacy of the strategy or of any strategy. There are some strategies, however, that allow us to earn money while we learn, and the ones I have been sharing with you fall under that category. For instance, in my opinion, it is possible to earn a living just trading golden and dead crosses. And the same applies to the minimalistic cloud strategy, or MCS for short, that we presented on Sunday. And don't take the name seriously. You know, my wife and I are always coming up with such silly names to refer to strategy or to differentiate among strategies. At some point, we developed a very nice indicator to trade bonds. And so guess how we call it? Of course, the Indy was named James. And the strategy, of course, 007. We had a lot of fun with it because the indicator appeared to work really nicely, but it was more for the fun of the James Bond thing. So humor me for now with the MCS to refer to the minimalistic cloud strategy. The fact is that the MCS allows you to start trading like a professional right away with minimal knowledge of technical analysis. And I think this is very transcendental because when it comes to methodology, you only need one thing that works. Someone left a comment about an hour ago that says, this is the only thing one needs in trading. And his or her comment really inspired me to talk to you about this. If that one thing works well with your personality, capital, risk tolerance, and all those components of your personal trading religion, you'll have your financial future guaranteed. You may not be a great analyst, but if your one thing works well and you're disciplined enough to follow it strictly, that one thing may be your passport to be a successful investor and or earn money consistently from the comfort of your home like everybody wants to do, working just 3 hours a day, etc. One of our members in the Technical Analysis Institute found that one thing when he was in his 30s, and he left his job at age 39 to be a full-time trader. He's not a great analyst, but he found his one thing, and that's what matters. That one thing, that one strategy can easily be something extremely simple, like the MCS. In fact, in my experience, for a strategy to truly work, it needs to be simple, easy, and unambiguous. Now, let me make sure I'm explaining myself well with all this, because no matter what strategy you use, if or when you apply that strategy in the context of the Elliott wave principle, you'll gain more effectiveness, better win-lose ratio, and of course, as a result of that, much more confidence, which in turn will help you generate better results faster. Certainly, you need to acquire more knowledge and develop confidence in your forecasting and analytical capabilities. That inevitably, of course, requires time to mature. But while you're working on that, why not learn something that can help you become independent, capable traders without having to pay thousands upon thousands of dollars in courses, alert services that don't work, and unnecessary losses? So my advice to you is that once that you find any of the strategy you are learning in our channel to resonate with you, then test it. Test it like a mad scientist. It could be your one thing. This next Sunday, we'll be posting a video where we address the key element to decide on a strategy. It should help you understand better what to do. Now, let's make a quick review of the MCS, the Minimalistic Cloud Strategy, so we are speaking the same language. I'm not going to explain the Ichimoku Cloud because we have a very good video where we cover all the basics. You can see the video here. I'm going to show you. That's why I have this open right here. You can see the Ichimoku Cloud Mastery here. It's really a full organized course on the cloud that is quite good, very simple, but complete. You need only 1 hour to invest on it, and it is more than worthy. But if you don't want to spend an hour learning the details of how to use the cloud, you really are not required to do so in order to use the MCS successfully. You'll still be able to apply everything we discussed on Sunday without being a cloud expert. So now let's have a quick recap of the strategy. So let me use a different chart because I have it prepared for you there. So basically, we buy when the lagging line goes above the span B from below, and we sell when the lagging line crosses the span B from above. In this case, the lagging line is the green one. Now, here we have very clean example of lagging line penetrated from above, then we sell. Right? That's a sell signal. Buy signal, we have, these are the ones that we use in the video. That's why I chose these ones. We can look at more in the moment. Here is an example of a buy signal. Now, where do we place the stops? Well, if we're buying, for instance, in this case, if we're buying, we place the stop at the lowest of the two previous relative lows. And if we're selling, we place a stop at the higher of the two previous relative lows. So what is a relative low? Let's draw this because this is the most common question that we get. Let's say that we have this formation, okay, where we have 3 bars. Some people use 5 bars, but 3 bars are good enough in order to have the concept of relative low and to place a stop. Now, the important thing is that this would be the lowest bar. And the important thing is that the 2 bars on each side of the relative low bar have the low of the bar above the low of the relative low bar. So this is the drawing. What is a relative high? Well, we will have the opposite signal. See, we'll have, this will be the relative high, and the 2 bars on each side will have the highs below the high of the relative high bar. So, for instance, in this particular case, we have a buy signal that appear around here, right? So where are the relative lows? Well, let's look for a bar that looks like this. Here we have a bar that made a low. The bar on the side is higher. The bar on the other side is also higher. So this is a relative low. Okay, is there another relative low that is lower than that one? Well, here we have another relative low. Look at this bar, and the one on the right has the low of the bar above the low of this bar, and the one on the left also has the low of the bar above it. So this is the second relative low. So where do we place a stop? Well, at the lowest of the previous 2 relative lows. So if the buy signal is here, we see this relative low, we see this relative low, this one is the lowest, we place a stop here. Easy, right? Now let's look at a buy example. Everything that I tell you guys applies to both buy and sell, but we have like a million comments asking always if this applies to sell only or to buy only. No, this applies to the same thing, to everything. So for instance, here we have the sell signal. Let's say that is around this bar. Which one is the previous relative high? Well, this one doesn't really qualify because all the bars are the same level. So this one does. Look at this. It's a high here, and the 2 bars are below it, right? It's like a middle finger. And so this is one. Where is the next one? Well, here's another one. So we have 2 relative highs here. So where is the stop? The stop is right there, right above there. Okay. Now here is an important question. What happens if when you enter the short, the lagging line crosses the span B back up? Should you exit before you get stopped out? And here is the thing to consider. In fact, this is the example. And to be honest, I chose this example for the video precisely because of that. Because this is something to keep in mind. It really doesn't matter when that happens. If you just enter the trade, apologies for that. If you just enter the trade and the lagging line goes back and crosses the span B in the opposite direction, you can do 2 things. And both of those 2 things are valid. You can re-enter, exit first and re-enter, and that may require a few iterations before it works. So typically you lose many times, not many times, but you will lose several times. But most likely you will get amply compensated when you catch the trend. This approach requires a tremendous discipline, because you may lose several times before you catch the big winner. Sometimes it's like in this case, well, you lose only once, but sometimes it's several times. But then you will catch the big winner, and the big winner is typically much bigger than the small losses that you may have. And what normally happens is that, before you start trading, you get all determined to follow the strategy mechanically, like a computer, like a robot. But after you have a couple of losses, maybe 3 losses in a row, you said to yourself, oh, this is stupid, I'm not doing this again. This strategy is not as good as I thought. And then you don't enter the next position, and the trend moves on without you. Keep in mind that one of the best ways to reduce the number of these situations happening to you is by using a larger time frame. That's why the very first example I gave you was with a larger time frame. And in a moment we're going to look at a larger time frame, so you can see how the strategy works so beautifully using much larger time frames. But majority of people want to scalp or make small swing trades, so they have to undergo those whipsaw things. Now let's say that we enter here when the lagging line penetrated that, right? So that's around this bar. Okay, and then when prices went up, the lagging line penetrated it again backwards. Well, that's to be expected, obviously, since the lagging line is really reflecting the price action. So that's to be expected if the span B is below that. So that's nothing to be worried about. But you can easily, okay, it penetrated it, okay, fine, I exit here, at the close of the bar, okay, you exit it. And now it penetrated back, okay, well, you enter it back. Again, in this case, it just happened once, okay, so no biggie, you lost a few pips there, and no biggie, you continue. Or the second approach is, if you discover that your psychology doesn't allow you to re-enter positions as often as needed, no one should criticize you for that, not even yourself. However, you need to know one important lesson. Keep in mind that lesson, because it's probably the most important lesson in trading, and that is learn how to lose and not to be affected by it. But let's say that still losing trade drives you mad. Then it will be best to hold your position until you are stopped out. It can work better psychologically and sometimes even financially. For instance, in this case, it worked better financially. And this example that I use on Sunday's video features that particular case. So you can see that we enter here, okay, we put the stop, as we said, this high here, and prices went there, but we didn't move the stop, we didn't exit, we just held to the stop. And then, we didn't lose anything. So the point is that you will have to test and retest this scenario several times before coming to a conclusion, because each case is going to be different. Like I said, in this case, okay, you wouldn't have lost anything, but there are cases where you would, and you would say, if had I exited it, then I wouldn't have lost that much. So let's say that your original stop is too high for what you want, then you may want to use the exit and re-enter the position. The truth is that both scenarios are valid. Now, let's talk about something else with the stops. And remember, I am not ignoring you. I just want to cover the few things that I want to cover before I check your question. So please don't feel ignored if you are writing. So you can see that the span B in red sometimes becomes flat. Yeah, it's a horizontal line. If it becomes flat above the price, like in this case, then it is called a bear flat. And if it is flat below the price, like in this case, it's called a bull flat. Now, the flats can be very long, like in this case, or very small, like in this case. They change size. You can see long, small, medium, medium, and very small, large. Okay, so those flats, and why I'm telling you about those flats are levels of support and resistance. And here's the thing: the longer the flat is, the longer that horizontal line is, the stronger the support or the resistance that area will represent. And that's something very important to keep in mind, because if you have something like this and it's penetrated, okay, that was to be expected. But if you have something like this that is penetrated, then, well, that's not really something that you would be expecting. For instance, when the entry of this case, then we saw that there's a long flat there, a big flat there. So we would not expect this to be penetrated. Our stop is there, and so that could play an important role if we decide to get out or stay in, because those flats are levels of support and resistance, and the longer the horizontal line is, the stronger the support or the resistance of that area. In fact, we actually define an uptrend when we see a series of higher and higher bull flats. Obviously, that means that the levels of support are higher and higher. And in the downtrend, we'll define a series of lower bear flats. In other words, a series of lower levels of resistance. Like in this case, you have resistance here, a lower level of resistance, 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 etc. So to trail the stops, it is wise to use those levels, particularly the long ones. So if you are in a downtrend, you trail the stops to the next bear flat, particularly the most significant one. So let's say that we were, and in this position we put the stop here. Okay, so now prices start coming down, and we see this one. We don't really lower the stop there because we know this is not very strong, right? But when we see this one, then we can lower the stop to a little bit above it, and then we can lower it a little bit more here. Okay, here we leave it alone, here we leave it alone, but here is a little bit more significant, so we lower the stop a little bit more. So you can see that this allows you, the strategy allows you to actually also trail the stop using these little, two lines there. Now, how many stops would you trail this way? Well, I strongly suggest you watch that size matters video. I don't have it here. Maybe we can see. Yeah, here it is. Size matter video. I strongly suggest you watch that video, because in that video we cover something very important, which is how to eliminate the risk as fast as possible. So, and once that you eliminate the risk, basically you enter the position with 3 units, then you eliminate the risk by exiting one position and then moving the second stop to break even. Okay, so now if prices goes against you, well, you already lower the risk, and you are only risking the original stop, but for one stop. But remember that you already made the same amount in exiting the first position. So if you are completely stopped out, you're having just a scratch. So that's why in this case, for instance, you would eliminate the risk very easily, very rapidly, and then exiting one, right? And then you will be trailing the second stop. Obviously, the stop that the original stop, you'll need to trail it as well, but not as aggressively, right? You need first to trail the second stop with each one of these flat lines, and then leave the third stop alone there, because it's not going to make any difference for you. Eventually you put it at break even, and thereafter, when you are accumulating really good profits, then you start bringing it together with the other stop or at least more aggressively than you were doing to start the position. Now, when do you exit the winning position? Well, basically when we get the opposite signal. However, there is something here very important to consider. And please take notes of this because it is very, very important. Let's say you have this beautiful winning long position, as we often have when using this strategy. Prices are moving in your direction, in this case up because you're long. And at some point, you see 3 consecutive closes below the span B. If your stop is being respected, or let's say, maybe your stop is still being respected, even though you are using those levels, right, to trail the stop. But let's say that you still have the stop in the previous one. Even if your stop is being respected, you may want to consider exiting your winning position anyways. And the reason is because when that happens, there is a high probability that if prices start closing 3 times in a row below the span B, there is a high probability that it's going to change direction. So you don't need to make that a rule. I'm just giving you that as a guideline for you to consider, because it's something that I have observed and that has worked really well when you do it. Sometimes you regret having done it, but it's safer. It's a nicer way to do. When you're looking at started closing. Well, in this case, for instance, we didn't have that situation, but there are other cases. Here we have one close, but that was it. But there are other cases in which the situation really does appear, and then we may want to consider exiting the trade. Okay, so let's look now at some examples with higher time frames. I'm going to actually pick whichever market. You can even tell me if you want whichever market. Well, let's use the same chart. I'm only going to use a higher time frame. Let's use one of my favorite time frames is 6-hour chart. So let's use this, and let's use whatever market. Let's say dollar. Okay, great. Okay, we don't have to travel too much. Look at that. Buy signal, did it work? We don't have to do anything else with it. It works beautifully. You may have lost a position before that, sure. But will you have lost this huge? No. So you will be compensated when you enter those positions that actually fail. So, okay, let's go to another one. What market do we take? Let's say, without looking. Okay, let's take Euro. Let's see, where do we go? Okay, let's see here. Where do we have the first signal? Okay, here we have sell signal, right? Look at that, how beautiful it worked. And we don't even have a close above the line. Amazing, right? So now here we have some closes. 1, 2, 3. So we can exit the position here. And notice that thereafter, the lagging line crossed the span B. So you can see that that practice of exiting works nicely. Okay, you can go through many charts like this. I don't have any chart prepared to show you how well it works. And it doesn't make sense that I show you, hey, look, this one doesn't work. Just doesn't make sense to me. You will find that on your own. But when it does, when that happens, then you really know how to manage the situation. You can either re-enter the position, or you can just hold to your stop. Obviously, if you know market context, and in what stage you are in market context, you're likely going to take much better positions, because you're going to take that crossing when you were expecting, let's say, the market to form a top, to finish a correction, or to form a bottom, etc. So then, of course, you will have, with market context, you will increase the effectiveness of this strategy, because you will avoid, let's say that you know how the Elliott structure works. It's 1, 2, 3, 4, and 5, right? So let's say that you recognize that you are on a wave 2 because you saw 5 legs here. You recognize you're on a wave 2. Well, you know that the corrections are precisely the ones that are going to be sideways. The 1, the 3, the 5, they're not sideways. They're going to be either going up or going down. So if you know the market context, well, you will avoid entering these crossings during the corrections, obviously. And that's why I say market context is key. However, a strategy like this can allow you to take really, really great profit without being the great analyst that knows Elliott waves and whatnot. Yeah? Okay, now I covered everything. Let me check that I did. We had a chart here, and let's check that we covered everything we wanted to cover. And if we did, then now I can take your questions. So, okay. So, what was that? We cover when to enter the position, where to place a stop, what the relative low and high pivot are, what happens if after entering you get the opposite signal, how to trail the stops, and when to exit winning position. So we covered it all. So now let me check your questions. I hope that you have already tested the strategy from Sunday already to this time, and if you did, please let me know what was your experience with it. Oh, hello everybody. I see many hellos, so, and I see many familiar faces, so to speak. Let's see. Oh, thank you. Jorge says thank you for this great opportunity. My pleasure, really. This is what I do for this is what I do for pleasure. It's weird, but I do. Okay, so I don't see questions coming in. Therefore, then I will consider that the strategy covered. I think everything is clear there for all of you. So since I don't see any questions, I will then say goodbye to you. Thank you so much for being with me today, and have a wonderful week, and go make some money. Really, go make some money, and then let me know, because it will be, that's the greatest pleasure I have after teaching, is seeing my students making money. So thank you so much, guys, and talk to you very soon. Bye bye.